Good afternoon. This is Blake Young, and you're watching the TheoTrade evening video for December 15th, 2022. Tonight, we're going to discuss a fall after the Fed. Very fascinating last couple of days. Significant sell-off over the last 3 days when we take a bigger picture look at that move. We responded and we reacted to CPI showing that inflation was slowing down. We responded and reacted to the Federal Reserve raising rates by 50 basis points, only to continue to close lower yesterday and start today with a gap down and close down. You can see in the move, purely from a technical perspective, we've created a widening pattern. Widening patterns are oftentimes strong indications of a new emerging trend. We broke through short-term support. We broke through the last month's low and did so on good volume. The sell-off seems to be showing that we are planning on more rate hikes in the future. The fascinating thing about this is right after the Federal Reserve meeting, if you were to look at the CME FedWatch tool, we were not only not pricing in future rate hikes in February, but we weren't even pricing in the rate hike into March, no matter how many times Jerome Powell said that they were going to continue to raise rates to a terminal rate above 5%. Well, that move is being seen today. That move is also being now priced into the CME FedWatch tool. We're now pricing in a 50 basis point hike with a 74% probability for February. And we're looking out now into June and July where we had no additional rate hikes. We're now showing that 5%, 5.25%, even 5.5% probability being priced in of 29, 30%, even 30% probability of getting past that 5% rate by June. Suddenly we're seeing, oh, maybe he was serious. And the market is now pricing in that higher rate hike as being a restrictive policy, which is what the Federal Reserve said they were going to do. The fascinating thing for me is as we watch that move, if we were to look at the dollar index yesterday, the dollar continued to slide. The dollar fell down and dropped and tested the lowest close in 6 months, approached the lowest support price in 6 months, and then today, after the European Central Bank, the Bank of England, and the Swiss National Bank all raised rates by 50 basis points as well, the dollar recovered. The dollar bounced higher, which is a game of relevance. If we're looking at the relevant rate hikes, we're seeing that the US dollar or the Federal Reserve is planning on raising rate hikes going forward, and the expectation is that the US will raise rates faster relative to the European Central Bank, despite the fact that the European Central Bank is also expected to raise rates by 50 basis points going forward as well. Bank of England and Swiss National Bank, they also raised the rates, and all three of those major currencies, and I will use the futures to show these, all three of those major currencies sold off when they raised rates today. This is an indication that, again, comparing the currencies, that the euro's 50 basis point rate hike will not be able to keep the euro stronger compared to the 50 basis point hikes and even the terminal rate above 5% for the US interest rates. We're seeing the euro fall down, close down. You look at the same thing for the 6B, the British pound. The British pound is also selling off, closing down, and closed down nearly 2%. That is a massive sell-off for a currency that just raised rates by 50 basis points. The Swiss National Bank raising their rates by 50 basis points. You can see as well we reversed off those highs, creating a tweezer-type pattern. Now, not looking to say this is an opportunity to trade the pound or the euro or the Swiss franc, but it really comes down to, is this bounce in the US dollar an indication that we're going to go back into an uptrend? Did we just carve out the low for the US dollar? And as you can see right where my cursor is, about 103.60, 103.50 was the key support back in June. We've created higher highs, higher lows all the way through there. Sharp reversal pullback, but now we've bounced again. If the US dollar is going to bounce here, and we're going to see more US dollar strength, and the US dollar's purchasing power is going to increase. If the US dollar's purchasing power is going to increase, then we might expect to see a continuation in sell-off in the S&P, in the major U.S. indexes. Now, if we're looking at the sell-off today in the futures versus the SPX index, you can see that not only did we have an acceleration to the downside, but as we spoke about in TheoTrade's main room, we overreacted to CPI, we underpriced it in, and we've continued to sell off, and we did so on higher volume. We're increasing the volume and increasing the momentum on that break of support. Today's move in the S&P this fall after the Fed is being backed by volume and has cleared out all the trading going all the way back to the last Fed meeting. We've eliminated the expectations that the Fed is going to slow down much more than what we've already seen. 50 basis points every meeting, 50 basis points at least in February, and probably 25 in March is pricing in this move lower. We could see the U.S. equity market continue to slide and fall. If we're looking at this as a relative percentage, and the U.S. dollar is looking to gain about 2% to 3% over the next couple of months, then we should and could expect the purchasing power of the dollar to increase by 2 to 3%, and therefore equities could continue to slide somewhere near 7 to 15% on the way down by March. And so from where we're at, if we go another 2% higher in the US dollar to 3%, then we could see 7% drop, 7.5% drop in US equities, which would push us back to the key lows back in September and October. So I do like this sell-off, and if you look at the move in the S&P futures today, you can see that we not only sustained that sell, we barely bounced off the lows. Dropping this into the intraday market, looking at a 15-minute time frame or a 5-minute time frame, you can see that we have established a trend yesterday, and we've continued that in a more rhythmic, systematic approach to selling. We've created bear flags, and this bear flag here is not saying that we're divergent. It's not saying that we can't go lower. In fact, as we speak, we're testing a move lower again. It looks like we have more room to go down. Tomorrow morning, we have a bunch of data on both services and manufacturing. We're going to see the Services Purchasing Managers Index and Manufacturing Purchasing Managers Index in the Eurozone and in the US and in the UK. The difficult portion we have to digest all that is that when we look at services and manufacturers, which is considered normally the early indication of whether the economy is doing good or bad, every single one of those reports, every single one of the European PMI, the UK PMI, and the US PMI are all sub 50. Anything below 50 is seen as market contraction. That the service sectors and the manufacturing sectors are showing slowdowns. And not only are we seeing slowdowns, we're seeing that the bounces in from last month to this month are either small or non-existent. In fact, we are seeing further slowdowns in the Eurozone. So here we are raising rates by 50 basis points in all these economies, which will slow down further growth, and we are already in a contraction type phase according to PMI in both services and manufacturing, which means that I believe that we are going to see further fears, further uncertainty, further indications of slowdowns while we are continuing to raise rates. So be aware of that. It's going to be an interesting day tomorrow, Friday, going into the end of the week. After all this behavior, we have seen recently that after the Fed meetings, we generally react positively to equities, but then sold off into Friday. We've already seen a big sell-off today. We're already seeing it set up for price patterns to push lower, and we probably see another bearish close tomorrow. So there we have it. Thanks for watching the night video for TheoTrade, and be very careful as we watch for the continuation of the fall after the Fed.